Hi. I have had quite a few people calling me, texting me, emailing me about some things that you've probably heard about. One of which is the proposed 50-year mortgage. Another is dropping the requirement for a minimum 620 score on Fannie Mae loans. Some of these people that have contacted me, I haven't talked to in years. So must be that these bits of information that are coming out are getting your attention. So I thought I'd take a few minutes and actually try to address them, give you some idea what's going on, and let you come to your own decisions. My first instinct, my knee-jerk reaction is that it's all, in fact, in my estimation, bullcrap. They're using a band-aid approach, employing smoke and mirrors to try to remedy a situation that folks that are supposed to be helping us improve our survival here in this country have actually done things to set up the problem in the first place. And now they're trying to use weird ideas and unusual solutions to fix something that they caused that they're not apparently willing to take responsibility for, but trying to make it look like there's some grandiose effort here to make things right. So at the end of this little talk, this little dissertation, I may not give you the tips that you usually get, like how to do something better, learning some technique, learning some ability to learn something about houses. But I think that part of my job is to make you as buyers and sellers more aware of what's going on. And just by being more aware, it brings you up a little bit and makes you more at cause and less the effect of what is going on in the environment, some of which seems to be quite sneaky in my estimation. So the first thing I want to talk about is this proposed 50-year mortgage scenario. Now, it seems like, and this is what's happening in the auto industry as well. It used to be you could get a 3, 4, or 5-year auto loan, and now it's 80 months or 84 months or something like that. So stretching out the time because the price of cars has gone up so much that now trying to get a car, even if you have good credit, is very expensive on a monthly basis. So now they're stretching that out. Now they seem to be applying this to the home mortgage scenario. And on paper, it sounds like, well, if you stretch the amortization period, the time in which you're going to pay the loan off, if you stretch that out far enough, that'll bring the payments down. And yes, it will. But part of this you have to understand is that if you stretch out the period, the amortization, the time it takes to kill off the loan, as it were, the longer you're going to pay interest. So the first thing you have to realize is that if you stretch that out from 30 to 50 years, the amount of interest you're going to pay on this particular purchase is potentially going to double. And the reasons for that is the interest rate is not going to go down, which is really what we need to have happen. The interest rate's actually going to go up. We already have 15 and 30-year mortgage periods, right? So if you get a 15-year mortgage, you have the opportunity to pay that loan off in a 15-year period. You make your payments on time and you pay them in full. That over the course of 15 years, you'll pay that loan off, right? The thing about that loan, though, is the interest rate on a 15-year mortgage is a good bit lower, but the payment is a good bit higher. So if you were going to take a $500,000 loan amount and compare a 15-year mortgage to a 30-year mortgage, you're going to have different numbers. So a 15-year mortgage, the rate might be about 5.6% if you're comparing that to a 30-year mortgage in the same time and under the same circumstances. That would be more like 6.25 points. So you have 5.6% compared to 6.25%. So quite a bit of a difference in the interest rate. So if you get a 15-year mortgage, that rate of 5.6% will get you a payment of about $4,100 a month, give or take. All right. You get a 30-year mortgage, $500,000 loan amount at a 6.25%, then your payment's going to be $3,000, almost $3,100. So about a grand difference. So if you go from 15 years to 30 years, there's about $1,000 per month difference in the payment at those interest rates, right? So if you can afford it, paying off your mortgage in 15 years, paying that extra $1,000 a month, if you can do it, makes a lot of sense. Now, assuming the same differential between a 30-year and a 50-year, so now we're adding 20 years to the term as opposed to 15 years, we're also, and using the same scenario, use the same assumption for a difference in interest rate, we're going to have this sort of scenario, which is Like I said, the 30-year mortgage on a $500,000 loan amount at 6.25% would be just about $3,100 a month. So now if we use a similar scenario of an expectation of interest rates between a 30-year and a 50-year period, assuming again that the 30-year mortgage might be at 6.25%, like I said, give you about $3,100 a month payment. If we go to a 50-year mortgage, assuming that that rate would be somewhere around 6.75%, which is a bit higher because of that longer period, we're going to have a mortgage of a little over $2,800. So the difference between payments is only about 250 bucks. So the question I have is, how much difference is that going to make? If you're buying a house and you have a $500,000 mortgage, does $250 make or break you in the determination of whether or not you can buy the house? Because if it is 250 bucks, then you might want to consider that that's already outside of your price range, no matter which mortgage program you might use. So in summary, the payment difference between 15-year and 30-year, with the interest rate the way it would be, makes about $1,000 a month difference. The difference between the 30 and the 50 only comes out to about 250 bucks a month. So we really have to look at whether or not that's actually going to make a difference in somebody's budget. If it does, fine. If a person can do it, fine. But the downside also is that it's going to take you much longer to get equity. It's going to take you much longer to pay off the house. Now, granted, people around here tend to keep a mortgage for 5, 6, 7, maybe 10 years. Hardly anybody pays off their house anymore. But with house prices going where they are, people may tend to stay in them longer. And so if you have that longer no payoff period, it's going to take you a lot longer to get the appreciation that you might have gotten, or get to a point where you can, in fact, pay the house off, or have it in a position where you can refinance it should interest rates become more favorable to us at some point down the road. So, in summary, my thought on this is that it's a rather shaky way to try to compensate for what's happened with home prices. And quite frankly, in my estimation, the reason home prices went up as much as they did was because of the lower interest rates. I don't think anybody would disagree with that. But the cause of that lowered interest rate over that period of time largely was artificial. It was caused by Fannie Mae, Freddie Mac, Ginnie Mae, and the Fed buying up mortgage-backed securities. And so at some point, when they saw that the economy was changing, then they dumped them. And that's what was responsible for that sharp, rapid increase in interest rates the end of 22 and into 2023. So suddenly we go from, somewhere around 3%, almost up to 8%. It actually did cover cross 8% for a little bit in a very short amount of time. And so we had an artificially low interest rate scenario coupled with now rates going back into what should be a normal range. 8% is really not off the historical mark. But because there was such a frenzy of purchases during that time, drove prices up. So now we have a affordability situation caused largely by the fact that it was artificially induced. And so now the powers that be in Washington now have to figure out, well, how are we going to keep this going? And so now the solution is things like a 50-year mortgage. And then on top of that, dropping out the 620 credit score as a minimum. So I'm not sure where that's going to land. I'm not sure as much the pros and cons of that. I do worry a little bit, since if you all remember the housing crisis that happened about 15 years ago, it all centered around, in many cases, people being qualified for mortgages that really weren't qualified. So if we start dropping out things that are qualifying people, my first question is as to whether or not we're actually setting ourselves up for another fall. So I'm a little concerned about some of the things that are happening in Washington right now with regards to mortgages, mortgage programs, mortgage interest rates, and things like that. Sometimes I think that leaving things be to do what they're naturally going to do is of benefit, but that's not always the case. And I don't particularly disagree with our government trying to ensure that we have a safe, sound, and secure economic environment. My question is whether or not the folks that are making these decisions are really as sane and logical as they should be. So anyway, I'll leave you make your decisions, do some research. I don't think the 50-year mortgage at this point is viable, really, because it doesn't create that much of a benefit. And I think I'm worried that dropping out credit score minimums may lead to people being qualified that shouldn't be qualified. And then we have more of another subprime situation that we had about 15 years ago. At any rate, I'd love to hear what you have to say about it. Drop me a note, email me, or respond to my Facebook page, or even better yet, subscribe to my Facebook page and get all my videos. But if you have any questions, please feel free to call me. You can reach me on my cell, you can reach me by email, you can text me, and I look forward to hearing your thoughts on this whole matter as well. Thanks for listening.